Hello, and also, hello.
I love being an underdog. I will take all of that feedback and we'll shock the world.
In just 5 trading sessions, I went from being an underwhelmed PayPal investor, questioning my investment decisions, to walking out the door, chest out, chin high, middle fingers in the air. So today, we're taking a victory lap, having gained 28% since I said to buy PayPal on February 4th. So to every hater who said this was a dead business, I told you so. And to all of those who followed me into the trade, you're welcome. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. Guys, if you like this video, please hit that subscribe button as well as the like button and then hit that notification bell. It really helps me out. Let's get into it. This is the daily heat map of the S&P 500 and it's very obvious to see there was a lot of green. Yes, red in some sectors, but a lot of green across the board. A very upbeat day. Semiconductors as a whole, excluding AVGO, outperformed. So too did software. Apple and Microsoft were kind of flat on the day, but Microsoft bucking the trend we actually saw here in infrastructure. This space is getting a bit of a bid after PanW's earnings yesterday, CrowdStrike coming off its highs and rallying into Adobe's earnings. We saw Meta was up 1.6%. That did help the overall communication services space. And then we saw really green action in this segment right here of discretionary, sort of like apparel, home builders, footwear, specialty retail. And that was after Target's earnings, TJX earnings, Urban Outfitters, they dropped their earnings and things were looking really good for this space right here. And I've actually been kind of bullish on cyclical discretionary stocks over the last couple of weeks. I think they're due for a rebound. A lot of them have been really beaten up this year, even after like a 6%, 7% rally in some of these, they're still down heavily on the year. But diving into this sector analysis more closely, discretionary was simply the best performing sector, up 1.3%, followed by materials. That's a very bullish day. The worst performing sector was financial. And based on the macro news we got today with the Fed minutes, you'd think that rate sensitive sectors like real estate and financials would rally the most, but it seems that a lot of it's priced in and rate cuts might actually be a sell the news event in the short term. Tech was up 0.6%, roughly in the middle, so too with industrials. And then we also did see stuff like utilities, consumer staples outperform the majority of sectors, and this had to do with some of the data we got today. Again, still a lot of fear under the hood. The big boys still positioning themselves for potentially what could be market volatility in September, perpetuated by seasonality, bad data, weak macro. And that's why we're seeing utilities and staples at the top here. In any normal rally, you would see these two names sort of at the bottom of the heap right here when it's a risk on day. And today clearly was risk on. Small growth, small core, small value outperformed their counterparts of the mid caps, large caps, and really smalls and mids outperformed large caps by a whole standard deviation. But it was still a bullish day for large caps nonetheless. And I do believe this is probably the start of the small trade getting back to those 52-week highs, which is about 5 to 7% away from its 52-week high at the moment. If it can go ahead and get that, the small trade is back on. But the real question is, why did we rally today? Well, number one, we got earnings reports from Target, TJX, Urban Outfitters, and all of their sales were a lot better than expected. CEO said very positive things about the consumer. Secondly, we got the Fed minutes, and it pretty much confirmed rate cuts in September. And now the question the market is grappling with is not if rate cuts in September, it's literally how many cuts. How deep are those cuts going to be? And then the third thing that really helped the market today was actually BLS data. We had 818,000 revisions through to March, and this right here just helps the rate cut narrative. Also, a couple of things. I saw a lot of data points that said we were going to get on the upside of 1.3, possibly 1.4 million revisions, which only get 800,000. That is bullish nonetheless. And even with these revisions right here, the labor market, the economy still remains strong, definitely deteriorating in the right way to perpetuate rates in September. And when you have rate cuts on the table, the stocks that are going to benefit in order is small caps, mid caps, large caps. And that's why we saw this type of price action today. And it was reverberated globally. Excluding China, we saw upbeat action in India, the southern part of Asia, as well as Australia, Europe too, at least most parts of Europe, and then North America and South America, with very select geographies being red. All in all, it was a fairly upbeat day in the markets, particularly those in US stocks. Now, diving into the technical aspect of the market and looking at everything in aggregate, we saw equities were very, very upbeat here today. The Nasdaq 100 was up 0.5%. The IWM was the best performing sector, up 1.3%. Although small cap quality stuff like the CAF index was actually up like 1.5%. So small cap quality having outsized returns. The RSP, the equal weight, was up 0.7%. Mid caps up 1.3%. And then the S&P 600 up 1.2%. So definitely a day for the small caps, mid caps right here. And we're actually seeing upbeat action in the after hours. The RSP up 0.1%, and then the IWM and QQQs also having slightly upbeat moves. We saw growth and value both performed equally here today, and the S&P 500 up 0.34%, or the SPY. What's also interesting is that volatility, the VIX did increase ever so slightly. We tend to see this in OPEX weeks where we have VIX up, stocks up. That normally happens, completely normal. But as long as the VIX doesn't absolutely blow out, this should normalize into next week when we enter the window of weakness. And then we saw very constructive action here in yields. The 2-year yield was down 1.3%. The 10-year yield was down 0.16%. 30-year yield actually did gain ever so slightly, but all in all, the yield complex did come down, and that's why bonds did gain ever so slightly. The AGG was up 0.19%, TLT was up 0.06%, but virtually flat. And then the dollar actually did fall ever so slightly. And when you're going to put all of your money into equities, essentially you're selling dollars, buying equities, buying risk assets. The dollar's going to fall as a result. On the back of the Fed minutes, gold did absolutely nothing, pretty much flat here on the day, but I think it's just digesting a lot of the gains we saw last week. And then silver was up 0.5%. And I think anytime we're above the $28 area in silver, that is bullish. And crude continues to do what crude does, and that's continue lower. We did see some changes in the gamma tape. We actually saw the S&P 500 put support move up. It was at 5,400 previously. It's now at 5,450. And pretty much when you see this type of price action, when you see the put support move up extremely close to the gamma flip, it pretty much means the options market is telling us there's a flaw in the market right here at the 5450 area. The risks, however, is that if the market just slices right through these, both these get moved down significantly, and that's often bearish for stocks. However, we do have a huge support zone right here at the 5550 area, 5450 area, and we're about 130 points away from the core resistance at the 5700 area, and literally a stone's throw away from all-time highs. If we actually take a measured move as to how far we are from all-time highs, less than 1%, 90 basis points is the S&P 500 from all-time highs. And in the context of the advanced decline line at all-time highs, more stocks than ever are actually gaining. In the trailing 2 months in the S&P 500, 54% of stocks have actually beaten the S&P 500, and this is one of the highest figures ever, and similar levels we saw in 2021. And at the same time, stocks are not even yet overbought. Look at the RSI trading at about the 60 area, so definitely above the 50 region, but not at that overbought territory just yet, meaning we probably are going to go ahead and get those all-time highs. This looks very, very constructive. There are risks that could derail us tomorrow, the biggest being PMI. If PMIs come in weak, expect to sell, but expect us to find support here at the 5550. However, if we do break the 5550, let's say on weak PMIs tomorrow, that does open up the 5450 very, very quickly. I don't think we'll get all the way there tomorrow, just depending how weak these PMIs are. But that is one risk factor. But if PMIs come in line, I think we're going to continue the price action we're seeing right here, which is buying dips, selling rips, and essentially just digesting a little bit of the price action we've seen in the last couple of weeks in the context of the market just moving higher as well. And then looking at the IWM Russell 2000, we can see that we've had remarkable rally, not quite as strong as the larger cap names. However, Russell 2000 is doing what it needs to do, and that is making higher highs, higher lows, and making 52-week highs. You can see that this, yes, I know we did actually break the low right there, but I would call that an equal low. We put in a higher low right here, higher low right here, high, 52-week high, and what we need to do now is continue to move up and break these highs right there. If we do that, the rally is back on. We can see that, look at the advanced decline line. at all-time highs in the Russell 2000. We know that rate cuts are coming. Small caps do really well in a rate cutting cycle. The IWM is not quite overbought as well. We were overbought right here, so I think there's still room to run in stuff like small caps. And I do think you want exposure to smalls, stuff like the IWM. I think we're going to go back to the 52-week highs we saw earlier this year, a couple of weeks ago. About 6% on the way there. But don't buy the IWM, guys. You want to buy something like the SP600, in my opinion, or an index like the CAF index. I think this is far higher quality. I know the chart doesn't look as good, but it's cheaper, growing earnings. And if you actually look at it in the last year, right, this isn't a 52-week high. This is an all-time high compared to the Russell, which is still making 52-week highs well off its all-time high. Or if you want to really look at something outside of the US, you could look at something like QSML. This is another ticker that I buy a lot, small cap quality ETF on the Australian market. But today was a bullish day and expect more of the same, especially if PMIs tomorrow come in line. And guys, looking at overall earnings today, we had Target and Macy's before the open, Snowflake and Zoom after the open. Now, Target actually had great earnings. They actually raised guidance. EPS grew 40%. And essentially the story there was that they were driving margins by charging reasonable prices and really giving people what they want. And when you do that, people are going to come to your store, buy your stuff. Macy's earnings wasn't that great. TJX beat on both the top line and the bottom line. Snowflake was very, very interesting. When last I checked, they were down like 5 or 6% here in the after hours. But you know what? They had great earnings. They increased customers 21% year over year. They increased revenue 29% year over year. They beat EPS, beat revenue. They actually did raise their guidance. It was a smidge. It was a $56 million raise, but a raise nonetheless. But either a lot was priced in or there was something in the margin front that the market didn't really like. I think NRR or like their certain segment of their recurring revenue actually fell 1 percentage point. So maybe the market was looking at that. But on face value, I thought the earnings were really good. And then I didn't get to look at Zoom's earnings, but I did look at the reaction after hours. And I think they were pretty much flat. So, I think the market was probably agnostic on their earnings. But all in all, I think today was a fairly constructive day, particularly here in the consumer retail space. I think this is going to be a tailwind for the retail sector into next quarter. And definitely a sector you want to have exposure to on the back of rate cuts. And the recent rally we've seen in the S&P 500 is one of the best on record in election years. This is what we've done in 2024. And we've had a stellar rally making higher highs, higher lows, hitting new all-time highs. And despite the recent volatility we've seen, parred a lot of the losses we made right there. And we're back to having one of the best election years on record. And volatility around this time of year is completely normal. August, September, October, and even as early as July, VIX seasonality tends to be very bullish. This is actually bad for stocks. The VIX and stocks have an inverse correlation. So if the VIX is bullish, that's normally bearish for equities. And if we do see more volatility over the next coming months, that is to be expected, especially with the macro concerns, rate cuts, the election, and geopolitical concerns. However, the biggest event likely to cause volatility this week is Jerome Powell's speech at Jackson Hole, and this is S&P 500 returns following Jackson Hole 1 week after, and there's not much of a trend to discern from this. Pretty much what we can say is that stocks tend to be very, very varied in what they do, and it really is dependent on what Jerome Powell says, what policymakers say, and the overall outcome of the event. But looking at more statistically significant data, this is S&P 500 performance after a 10% January to July, after we've had a negative first 2 weeks in August. After a bullish year, the entire August period is actually quite bearish. In the first week of August, we tend to see negative returns, and we did so here in 2024. That actually set up this data set, and then from 14th to 31st of August, we actually see 9 wins, 7 losses, average return a negative 0.53%. However, that is the only negative period. Then September, October, November, December, and January, all positive. Some months, like November, up 3.67%, 14 wins, 2 losses. Very, very bullish. For the full period, August 14th to January 31st, 9.34%, 14 wins, 2 losses. This is very, very bullish. And pretty much what this data set tells us is that yes, we can see volatility in the near term for sure, but buy those dips because in a bullish year, the second half of the year, including January, tend to be very, very strong with very minimal drawdowns. And as we go into a rate cutting cycle, we need to be aware of what we can expect, particularly in the Russell 2000, which hasn't even hit a new all-time high, as the major indices have mid caps, large caps, the S&P 500, the mega caps, and most of the rest of the world. Now, this is what normally happens to the Russell 2000 after the Fed cuts rates, and you could see that on average, 1 year later, 12 months later, the Russell 2000 normally returns just a smidge over 10%. However, the maximum range can be as high as 50%, and the minimum can be as low as about 12 to 15% to the downside. The risk to reward right here is asymmetrically skewed to the upside. However, when you dive deeper into the data and have a look at Russell 2000 returns when no recession is followed, and I don't think we're going to see a recession, jump to the macro portion of this video. I'm going to tell you why. When there's no recession, the Russell 2000 on average returns about 15%, and you could see outsized returns at the maximum 12 months later of about 20 to 22%. But this is where it gets interesting, because 12 months later, downside returns are less than 5%. And again, asymmetrically skewed upside for small caps. And based on their valuation metrics, I think the Russell 2000 is going to do very, very well. And the opportunity here is insane. We do know that rate cuts are coming. Right now, priced into the market into December 2025 is about 210 basis points worth of cuts. That's pretty much a 25 basis point cut every single FOMC from now until December. So September, November, December, January, February, March, 25 basis points all along the way. Do I think we're actually going to get this? I don't know, but I do think we're going to get about 100 basis points worth of cuts before the middle of next year at the very minimum. I think we're probably going to get 25 to 50 basis points this year. And with rate cuts on the way, global liquidity is actually on the rise following its long-term cycle. And you can see in periods where global liquidity is a net positive for markets, stocks do very well. Look at what we did here in 2020 into 2022, as well as 2012, 2013 into 2014, 2015, 2016. These are very bullish periods for stocks, and this is where we are right now. You want to hold equities in periods where liquidity is a net positive for the market. Stocks do extremely well in such scenarios. Now, let's go ahead and talk about some macro. This is Goldman Sachs global GDP forecasts for 2024. Globally, Goldman Sachs is predicting about 2.7% in global GDP. The Bloomberg consensus is about 2.7. The US is at about the 2.5% region, between 2 and 2.5. You can see that the US is tracking better than almost every other country, except China here tracking at 4.9%. So robust growth in all parts of the world, except the Euro area right here. But we'll see if this goes up, especially as we see an improvement in the manufacturing space. Still fairly subdued growth, but definitely not recession territory. Then we actually have a look at 2025 expectations for GDP. Globally, the consensus is again 2.6 to 2.8%. The Euro area at 1.25 to 1.5%. So the Euro area definitely seeing slower growth in that market. Maybe that has to do with regulation, immigration, and a whole bunch of stuff going on in Europe. There's a whole bunch of factors, but we're seeing slower growth in Europe. That's why you probably don't want to have a whole heap of money in Europe. The only money you want to have over the next couple of years is high quality companies. And then we have China's next year GDP growth sitting between 4 and 4.5%. And the US, there's a wide discrepancy. Goldman Sachs see around the 2%, 2.25% mark. The Bloomberg consensus see 1.75%. It's going to be very interesting to see which way these converge. The truth is often somewhere in the middle. I would say 2% seems the most likely outcome. So looking ahead for the rest of 2024, 2025, when it comes to the macro places you want to be, the US, and if you can handle the risk, maybe look at China. Stocks are trading at extremely cheap valuations, but the stocks trade cheap there for a reason. There's a lot of problems with China. That being said, let's look at the labor market, because along with GDP and economic growth, the labor market works hand in hand. And you can see that US wage growth has fallen steeply from its highs in 2022. However, year-over-year wage growth is no longer fading. We saw a mild uptick. This is really good for the consumer, and wage inflation still at 3.2%. And wage growth is actually rebounding in all sectors, low, middle, and high wage, with the biggest year-over-year increase coming from lower wage sectors, 3.4% against 3.1%, but fairly close in aggregate. And the average, I would say, is about 3.3, 3.2%. And while this is actually good for the consumer, there is a couple of concerning things. This is corporate transcript mentions, and you can see in this earnings season so far, labor costs is one of the biggest mentions across the board in tech, real estate, materials, discretionary staples, energy. In every single sector, labor costs is a huge mention, and that's probably because wage growth and employee compensation has actually outpaced overall inflation. This means that companies are having to pay up to keep their employees, and this has its pros and its cons. The pros are consumers have a higher disposable income that's actually beating inflation, and they're gaining pricing power. The problem with this is corporations oftentimes reduce labor costs not by lowering wages, but by simply laying people off. They'll never actually decrease an employee's hourly rate. The way they decrease their overall payroll costs is just to lay off workers. However, we'll have to see how this translates into 2025. Labor market is still robust, wages are growing very healthily, and economic growth is on the up and up. In that scenario, you want to hold equities because the consumer normally hangs in there. And until we see this fall apart or mass layoffs come into the market, the macro in the year and now looks strong.